In our previous videos, we have already seen how to firefight a call ratio spread on the upside move of the market. But today, we are tackling a different challenge. What do you do when the market goes down? Should we be happy with just to not lose money in this scenario? Or can we do something systematically to improve profits? In this video, I'll show you how we took a trade that was headed for a negligible profit and used a proper adjustment process to secure a very significant gain. If you think a falling market means a boring month for your call ratio spreads, after seeing this video, you will definitely think it again. Welcome to another video by the Option School, and I am your friend Pradeep Singla. Let us look at a real market scenario from July 2025. We initiated a standard call ratio spread of 1 is to 2, where if the market stayed sideways or went down, our initial maximum profit as shown in the payoff diagram is only 135 rupees. While this is a no loss zone if market goes down, but the question is, can we get some better results? Can a no loss zone or a very tiny profit zone be converted into a profitable zone without undue risk? This is what we want to see. Let us see the whole process of how to increase the profitability and run this trade till a decent profit comes or expiry comes, whichever is earlier. It takes a lot of backtesting to bring these real market scenarios to you, and your one like definitely helps in improving the visibility of the video. So please click on the like button. So a ratio call spread is made when market is at around 25,575 with an upper break even of 27,201. This is created on 1st July morning 9:30. On 3rd July, markets went down a bit and the trade was showing a profit of 161 rupees at almost closing time. Although the max profit on expiry was 135, but obviously this is not expiry day and hence it was showing slightly more profit. But one thing is sure that we are not going to get much in this case in case market stays at a lower level. Obviously something was to be done, so we booked these two calls of 26,900 which were sold and brought them down to 26,700. By doing this we got 9 rupees extra, so we had two lots, so 9 into 2 18 rupees we got extra. 18 multiplied by 75, which is almost 1,350 rupees extra premium we got in the trade. Remember, our buying is still at 26,600. What we have done, we have sold now 26,702 calls. So ratio spread is still 1 is to 2. So as seen in the payoff diagram, the maximum profit on the downside move of the market, which was earlier only 135 rupees, now it became 1462 rupees, which is much better than that 135 rupees. This is around very close to 1% because this kind of a trade would take somewhere close to 1.6 lakh rupees. After a few days, that is on 10th of July, market still remained sort of bearish and we are getting around 915 rupees profit in the trade. Expiry is still far away and market is now at 25,370 levels. Even the second set of calls had hardly any premium left. Remember, our buying is still 26,600, which is around 1300 points away from the spot levels. We booked those extra calls, so we sold two calls of 10 delta to get some extra premium in the trade. Why 10 delta? Mainly because there is a very low chance of market touching the level, although nothing can be ruled out. It's all risk is always there, but this was a calculated risk taken. Now to keep the margin requirements intact, we kept the bought call as it is, although it was also losing money. So the trade got converted into a bear call spread, but there was still a ratio. Bear call spread with a ratio, two calls sold, one call purchased. Another thing possible was that we buy another call of 26,600, which is 11-12 rupees. But we said, let us not do it as of now because we have not used any extra funds. A. B. In case market reverses from here, we will buy that call to make it a complete bear call spread of two lots. Markets remained subdued, and on 15th of July, the trade was giving us a profit of around 38.47 rupees. So we got a great opportunity to close the trade at around 2.35% profit, which is sufficient enough, and we closed the trade. Although there was some more potential left in the trade, definitely, but then why to take risk? If market has obliged me to give my required profit in first 15 days only, I would never force myself to the market for full month. Reversals can be obviously dangerous for me, so better to book profit. Profit booked is my profit and profit on screen is not my profit. So sort of a decision is required to be taken here by the trader. Although if we see carefully, the trade still had 22 rupees into 75 was still there. And on expiry, the trade gave 5,475 as a profit as market tanked down only. But that would mean sitting on risk for another 16 days. Now it purely depends upon trader to trader and his decision matrix where it decides whether I want to book my required profit on 15-day or I want to sit in the market for full month. Initial payoff diagram showed that in case there is a down move in the market, we will get only 135 rupees as a profit, but adjustments gave us 3,847 rupees, which is 2.37% on the deployed margin. Can the profit percentage be further increased? Obviously, yes, if we use a small margin trick, which I have explained in my earlier video also. This can be done by buying additional weekly calls of very little price and margin will get reduced to around 50%. We'll forego very little money in buying of those calls. So if our margin requirement gets reduced by 50%, definitely our ROI would increase to 4.7%. And this is happening when we have booked the whole trade in the half of the month, 15th of the month, we have booked the whole trade. You can go through this margin reducing video. If you have not gone through it so far, it will be really helpful in all your selling positions. You can download TOS app through link given in the description. If this video helped you, please hit the like button and subscribe to channel. See you in the next video. Thank you.